Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only and longest running expert. We are so lucky, Anna Kelly. Hi, Anna.
Hi, so good to be here with you again.
Yes, this has been fun. I think 3 years doing this together most weeks. It's pretty awesome. So thanks again.
You're so welcome.
I want to talk about a particular asset that I think you do really, really well with intention. However, it happens to be a part of the real estate cycle or real estate industry that frankly scares me. Why it scares me is it has got the moniker of easy money. It is also a part of the market where non-QM lenders have started to lend in great numbers to very inexperienced folks. And I think there are some vacation markets that are now so concentrated with not A class. A class will likely be okay, but B and C class, Airbnbs, VRBOs, short-term rentals, that I really could see Airbnb being the single reason that some second tier or vacation markets go bust. And what by bust, 20% price drop. I think looking at the inventory of listings in some of these markets, Anna, it is frightening what I'm seeing.
Yes.
What do you think?
Yeah, I think you're right. I think, real estate in the last year and a half, especially, you would think people would have been really scared by the pandemic and said, hey, there's eviction moratoriums and, people can't travel to vacation spots because cities are shut down. You'd think that would have made people a little more cautious, but people are excited and greedy and have the fear of missing out. And they see values going up and people traveling and they say, hey, this will be easy money. Like we talked about in video number one, right? And so we had a lot of investors really cause significant increases in vacation rental prices, way more than the general housing market that's gone up 20, 29%, 35%. Some of these beach towns, and I'm a beach town investor, but some of these beach towns and even little, not very well-known spots have skyrocketed in value. And if the travel doesn't stay up to basically the best case scenario where you're fully occupied at those best case rents, a lot of these deals were very, very lean. They paid so much for the property and their debt was expensive because these non-QM loans, for those of your listeners that don't know what those are, they're basically non-qualified mortgages. So they're kind of like easier loans. You don't have to have your tax returns or your income to qualify. They pull your credit, make sure you're credit worthy, and they look at the income that the property expects to generate. And as long as you make 10% over the debt on that number, you get the loan. But the loans are at a 2.5% higher interest rate. So the debt payments are much higher. So the risk is that the margins are so thin, there's not a lot of wiggle room. A 10% profit margin could be killed with a 10% decrease in travel, for example. So they're riskier when you do it with non-QM debt for sure. So there's definitely risk there. I agree.
And again, I've been doing this a long time. And unfortunately, the last 18 months probably have been the best time for the next 2 decades for that market, right? We essentially couldn't have international travel. People wanted to get away. They didn't want to do hotels. So houses were the right answer. And again, the people that did it right, like you that have beachfront, like you can't replace that, made a lot of money. Some of you went out and create courses that brought others. Then you have this, what really drives me crazy are the people now pushing arbitrage, right? Yes. I'm going to go lease something from a landlord and then basically sublease it. I mean, all of this easy money, it's easy. Anybody could do it. Just brought the masses overpaying, bad debt structure, and the lenders didn't help. The lenders were looking at the rents, or I don't know, I guess it's called rents, the dailies going, hey, this is great. You can afford that. And then you paid more and more, not realizing because they didn't have experience that will be the best summer ever. I know people in the Airbnb space that for the last 12 to 18 months, they averaged 82% occupancy. The last 2 months, they're in the 60s.
Yes. Yes.
That is going to break a lot of people.
Yeah, it really can. And especially on the lower end properties, right? Because now that we're heading into this mass inflation, and even though it's supposed to be just under, 10%, food, gasoline, housing are all up over 25%. The numbers are kind of in that 25, 30, 35%, right? Yeah. And that's the substance of people's non-discretionary income. Discretionary income for the middle class and below is being squeezed so tight that a lot of them are saying, you know what, we can't afford this vacation. So if you have a little 1 or 2 bedroom condo, lower end, just competing with hotels, you're going to be a lot more hurt because those people won't travel. I've chosen to invest in what I call luxury vacation rentals. So they're higher end. And part of the reason I did that is because I knew that if we do have economic pain, which we've been talking about, we've been experiencing for 2 years, right? Whether we go to more inflation or whether we go to recession, either bet is not great, right, for the economy. Those who are making above average incomes and upper middle class to upper class, they're still traveling. Unfortunately, and I feel a little guilty saying this other than I've worked so hard for what I have, right? But the inflation hasn't hurt me at this point because I've created an income level that allows me to sustain it. Is it fun? No, but I can handle it, right? I'm still vacationing. I'm going on 5 weeks of vacation despite $5 a gallon, gasoline, because I can afford to do so. So those that are in middle class and above who aren't living check to check, they're still going to rent my high-end bookings. And mine are all something that I call a unique value proposition. They're better than the other properties around. They've got the best views, the best amenities, and I'm going to smoke my competition because those that are willing to pay $1,000 a night or so, they want the best of the best, right? So a high-end property that's still drivable, that's on the water, that's in the mountains, those people are going to continue to rent. And I'm booked solid, both on the beach and in Pigeon Forge. I'm completely booked. Nice. Where a lot of those smaller operators arbitraging or really small units that look just like, 50 others that are just like them, they're the ones that are panicking and they're not doing as well. And it's unfortunate.
Yeah. And where this is going to go is I think there are some communities that are going to see a pretty good price drop, right? A lot of people swam in, overpaid for marginal inventory. They had an okay year, so they probably doubled down. Ouch.
Yeah.
And now it's not funding and they probably have some savings, but this is not going to end well, right? If you need 80% to break even and now you're at 62, that's, and again, this could be some foreclosures coming. This could be some forced sellers. Non-QM lenders may take properties back. There are some, I'll call them second tier cities or locations.
Yes.
That got way too expensive and now they're going to adjust. And I think the adjustments could be north of 20%, maybe not this year, but definitely next year. I think there's some real pain coming to some of these that markets that got too hot too fast.
I agree. And a lot of what happened too, and I saw this especially in areas like Sarasota, which by the way, have a huge influx of increased inventory, is that people started buying homes in normal neighborhoods in those markets, but not really on the water. So let's buy in a neighborhood that has a pool and it's only a 30-minute drive to the water.
Yeah.
Well, people aren't going to rent those. And if housing values start to come down because the demand kind of teeters or a lot of people start selling, they're going to come down anyway. So then that could hit you as a double whammy, not only not getting the travelers, but your home value coming down. You can't really sell it and not be underwater. And so it's definitely unfortunate, but I do see it coming. I'm already seeing it in people who bought mediocre properties, even in the Smoky Mountains. So the Smoky Mountains, I'm in Pigeon Forge doing great, but I bought very strategically. I'm like 2 blocks away from Dollywood, which is now the #1 traveled amusement park in the country, but it's cabin feeling, right? So I got the location and the cabin. A lot of these people that bought really expensive cabins or really low-end condos further away from the activity or not as nice, they're getting huge declines in people coming and traveling. And they're going to be hit really hard, whether they're high end or low end, because they didn't have that unique value proposition and they just simply way overpaid and did it with non-QM loans.
Yeah, this is coming. I really do think there are some people that are going to be hurt. There will be some locations that see a pretty big hit once people realize that Airbnb is amazing if done right, but man, there's so many people pitching it. This I see it all over my market. This like know nothing 1950 rant. I'm like, really? Okay, great. When you can't go anywhere, and Yosemite's an hour away or whatever it is, I get it. But when the world opens back up, what seriously? Are you kidding me? What are we doing with that? And oh, by the way, you overpaid so much. Your debt structure sucks. You can't turn it into a monthly rental. It's an alligator day one.
Right, right.
It's
I
going to
will
hurt.
say this on the positive side. So I've still bought several short-term rentals. I think I've bought 3 this year, right? And I've helped some of my investor students buy short-term rentals. But we're always talking about, how do I balance risk? How do I get that 30-year debt, right? We're not doing them with anything other than 30-year mortgages that were pretty low interest rates. And I'm saying spend a little more and get the oceanfront, right?
Yes.
Spend a little more and get the ones that are as close and as nice to all the amenities that people are going to come for. But here's the other thing I told him, Michael, that I think is so important. Don't panic if your value comes down a little bit. We know we're buying at the height of the economy. We know we're buying at a high price point. And so our values may come down if we hit a recession. In a recession, one of the first things to go are second homes that people are like, this is a discretionary thing. We've got some equity. Let's sell it. Then vacation rentals, right? If they're not doing well, they're going to panic and they're going to sell them. So values will start to come down as inventory increases and people try to sell. But if I'm a long-term buy and hold investor, I can weather that. How do we weather that? We have reserves for when it doesn't rent as well. We only buy properties that have at least 3 or 4 years of rental history, right? So I'm not going into a neighborhood that's never had Airbnb saying, let's buy that property. I'm buying a house that's been rented for 3 or 4 years, pre-pandemic, post-pandemic, and getting 4 years of rental history. So I can kind of see an average of what does it do in normal times, really hard times since then, average it out and be prepared to hold it for the long term. Maybe you have a year or two that you don't cash flow, but typically in a recession, Michael, this is to play devil's advocate a little bit, people stop traveling internationally. And with all the geopolitical risk, they'll stop traveling internationally. So in recessions, normal recessions where gas prices aren't $5 a gallon, vacation rental rents actually go well up, even though the values start to fall. So I love that as cash flow, but you've got to be in great rentals where people really want to go. The $5 gas is kind of a wrench in this that is slowing things down. But if you're a long-term buy and hold investor, buy right. Make it a good deal day one. Have some cushion. Don't bank on the best numbers. Bank on something that's, average long-term. Have some reserves so that you can continue to make that mortgage payment. And then you hold them for the long term. And even in these times, it's going to be a good investment over the long term. Too many people are too greedy and their numbers barely pencil. They get a loan, so they think they're great, and they have no risk mitigation and no backup. And those are the people that are going to get really hurt.
Yeah, I see that as well. Again, there is a right way to do it. If you're looking to do it, I recommend reaching out to Anna because I have never done it. So I have only opinions. She has experience. Anna, how can people find you?
Great. You can follow me on social media, Anna Kelly, REI Mom, here and on my playlist and at reimom.com.
Thank you so much.
Thank you.